When your company is growing and there is more work to do, what is usually the first solution that comes to mind? Hire another employee. Accounting is overwhelmed. Hire another accountant. The finance team needs help. Hire another financial analyst. There are too many administrative tasks. Hire another administrative employee. The business owner is spending too much time managing operations. Hire an operations person. This sounds logical, but there is one important question that many companies forget to ask. Does this position really need a full-time employee? And there is an even more important question. Will hiring this person actually increase the company's profit or simply increase overhead? Because when you hire a full-time employee, you are not only paying a salary, you are also paying payroll taxes, benefits, insurance, paid time off, recruiting expenses, training expenses, management time, software, equipment, office costs, and perhaps the biggest hidden cost of all, the risk of hiring the wrong person. At the same time, outsourcing has its own risks. Will the outsourced team understand our company? Will they respond quickly enough? Will they understand our culture? Can we trust them with financial information? Will quality suffer? And sometimes company politics creates another problem. A department may say, "We need our own employee." A manager may feel that having more employees means having a stronger department. Employees may be uncomfortable working with an outside team. Leadership may worry that outsourcing will damage company culture. So today, we're going to look at this question from a business and financial perspective. What are the real pros and cons of hiring full-time employees versus outsourcing? What does each option do to your profit and loss statement? When should you hire internally? When should you outsource? How do company politics influence the decision? And most importantly, what if a BPO partner could operate according to your company's culture, procedures, communication style, and internal controls without forcing you to take the financial risk of hiring an unqualified employee? Let's break it down. Part 1. Full-time employee. What are you really buying? When companies compare an employee with outsourcing, they often make the first mistake immediately. They compare employee salary versus outsourcing fee. But that is not the correct comparison. The correct comparison is total employment cost versus total outsourcing cost. Let's use a simple example. Imagine you want to hire an accounting or finance employee. The salary is $70,000 per year. Many managers will put $70,000 into their budget. But is the employee actually costing the company $70,000? Usually not. You also have employer payroll taxes, workers' compensation, health insurance or other benefits, paid vacation, paid holidays, sick leave, 401k contributions depending on the company, laptop and equipment, software licenses, recruiting expenses, background checks, training, management, HR administration, and possibly office space. Depending on the company, a $70,000 employee may realistically create an annual company cost significantly higher than the $70,000 base salary. So the first lesson is, never compare outsourcing to salary alone. Compare outsourcing to fully loaded employment cost.